afternoon, everyone, and thank you for joining. I'm Shoshanna Harrow. I'm one of the lawyers in Covenant Review's London office, and I am joined by my colleague, Yalgin, who specializes in leveraged loans while I focus on high-yield bonds. And as we do each quarter, Ahu and I are going to spend about 30 minutes today highlighting some of the trends and covenant developments that we've seen over the last 3 months. You'll see that the chat function is available for you on the webinar. So if you do have any questions over the next half hour, please do drop them in. We may not be able to get to them during the webinar itself, but we will certainly come back to you separately. I believe the React function is also live. So if you feel moved to send us some emojis, those are always welcome, hopefully the happy ones. And last but not least, there is a survey button that should be highlighted for you now. And you'll see it again at the end of the webinar. We'd really love to have your feedback if you have a minute to fill this in. And with that admin out of the way, let me turn now to documentation trends in the primary market for European high yield. As I'm sure you all know, volume was robust over this quarter. June was the busiest month out of the three, highest monthly volume this year. Yet again, as I say, every quarter, refinancings made up the vast majority of the offerings. According to our colleagues at LevFin Insights, they represented about 72% of total issuance for the quarter. If you include bonds that were issued for general corporate purposes, that rises to a whopping 87%. Of those deals, of course, most were replacing existing bonds with new bonds, so pretty much like for like. But we did also see a handful of debut issuers who turned to the bond market to refinance loans and other debt. And we also, which is quite welcome, had a few LBO and M&A linked deals in the quarter, along with a handful of dividend recaps. So we did have a decent supply of new money. And as for what that all meant on the covenant front, well, on the whole, is what you would expect. Certainly, if you've been listening in on these quarterly webinars, the bond-to-bond refis continue to make selective changes to their existing covenant package. For the most part, of course, that meant looser covenants. So we would see new and upsized baskets and looser ratios and more addbacks, more calculation flexibility, that kind of thing. But in some cases, trickier credits had to dial their flexibility back slightly. We saw blockers added, some ratio tests tightened. In a couple of deals, we saw portability that had been a multi-use feature limited now to single use and tweaks of that nature. And of course, some deals did both. They would maybe tighten a ratio here, but add an asset sale step down there. So a bit of a give and take. Not surprisingly, the new money deals tended to skew more towards the aggressive end of the spectrum. This is where we saw really outsized capacity permissive ratio tests that excluded substantial debt or allowed incurrence on a no worse basis. Really weak build-up baskets in the restricted payments covenant, quarterly zero floors, limited conditions, if not non-existent conditions for access to the basket. We saw flexibility to effectively invent an EBITDA number with a host of addbacks, and then the ability to permanently resize baskets based on that fictional EBITDA thanks to high watermark provisions. So net, this pattern that we've really been seeing for some time now continued over Q2 this year. If we look just at a couple of data points, focusing here on sponsor deals, bit of a mixed bag. Day one capacity increased quarter on quarter. As you can see, there were some pretty chunky amounts available right out of the gate for debt, for value leakage in the form of restricted payments, for unrestricted subsidiary investments. But interestingly, as you can see on the bottom half of this slide here, some of the other key terms held steady or actually got a little bit tighter. Now, some of that's just down to deal mix. In particular, that heavy amount of refis that I mentioned may have just been rolling forward whatever was in there to begin with. And so that can skew a little bit our trend lines. But what I would call out here on this slide is the uptick that you see in the quarter in caps on EBITDA addbacks and a slight uptick in the percentage of deals that have a J crew blocker. Both of those sound like an improvement from a buy-side perspective, more protective, but we often see those as kind of camouflaged provisions rather than really helpful ones. On the addback front, you'll see quite often a cap that applies to a particular prong of the EBITDA definition, but if you read all of the other prongs in that definition, or ratio definition or a financial calculations provision that's elsewhere in the document, you'll find that very similar addbacks are permitted on an uncapped basis. So they've closed one door but left all the windows in the house open for addbacks. And similarly for the blocker, we see them get dropped in to kind of tick a box and give an illusion of protection, but in a lot of cases they're quite limited or badly drafted. So it's really kind of an illusory protection. We saw a couple of new and notable things that I wanted to highlight over the quarter. First up, we saw in a cross-border deal a restricted payments build-up basket that accrued capacity based on the greater of a consolidated net income, 50% of consolidated net income, and EBITDA less 1.5 times interest expense. That choice is unusual. Of course, the norm is just that 50% C&I metric. We do sometimes see an EBITDA less interest expense metric, particularly for telecoms issuers, but the choice of the two is a development, sort of moving us towards a formulation that we see in loans sometimes, which often have a greater of or even a greatest of formulation that allows the choice of the two metrics I've already mentioned, plus a retained excess cash flow metric. It's going to be interesting to see if we continue to see this type of choice make its way into bonds. We also saw a few deals over the quarter that had carve-outs for restricted payments made with distributable asset sale proceeds that represent a really chunky amount of EBITDA, often with increased amounts permitted to leave the restricted group if the company could meet one or more ratio tests. Now, these aren't brand new. We've seen them previously, but there was a noticeable uptick this quarter. So again, that's something we're keeping an eye on. We saw a voting cap in a deal, Nurion, that we thought was worth taking notice of. And under that cap, if a holder, together with its affiliates, holds more than 20% of the outstanding notes, then the excess gets disregarded for voting purposes. But the issuers can override the cap if they choose in relation to any individual owner and their affiliates. So that could really facilitate a vote rigging in a liability management scenario. It's a particularly issuer-friendly version of the cap and one that we weren't too keen to see. We also, over the quarter, saw some incursions or attempted incursions into call protection. Capsigel, for example, aimed at a 7 non-call 2 structure that was ultimately unsuccessful, got dialed back to 3 years non-call. The dam appears to be holding on that front for now, but we may see some other issuers push for a 2-year non-call in 7-year deals. And in addition, what we have seen get through repeatedly now in deals is a really subtle shift in that right to redeem 10% of the outstanding bonds at 103. It's moved to the right to take out 10% in each calendar year rather than in each 12-month period. And so depending on when notes are issued, you could end up with the right to take out 30% at 103 in just 14 months. You could take out 10% in December of calendar year 1, 10% sometime in calendar year 2, and then 10% in January of calendar year 3. So, chipping away at call protection. And then last but not least, I just wanted to mention a tweak to drag along rights that we've seen in a couple of deals. Now, for several years now, it's been quite standard in European high yield to see a provision that says if there's a tender offer or some other offer to purchase like a change of control offer or an asset sales excess proceeds offer, and holders of at least 90% of the notes tender, then the issuer can take out that stub at the same offer price. We've recently seen that expanded very slightly to include exchange offers, meaning that if 90% of holders of 90% of the bonds agree to exchange, then the issuer can essentially compel the remaining holders to also exchange. So it's moved beyond this permission to redeem for cash at the relevant offer price to sort of a forced exchange into new debt or whatever the exchange offer consideration happened to be. And again, among other things, that could have some pretty interesting implications in the LMT context. So with that, I wanted to talk also a little bit about some pushback that we saw. We didn't really see any widespread tightening. As always, pushback is pretty rare and success is even rarer. But we did have some pockets. We've seen, as we discussed, this resistance to some of the call protection dilution. We've seen a few high watermark provisions get removed. We've, as always, seen blockers added. Sometimes, as I mentioned, those are more illusory than really protective. We've seen Addbacks dialed back a bit. Maybe a cat gets added or made a little bit tighter. We've seen some, 200% pick your poison and equity credit debt baskets get dialed back down to the more standard 100%. And in a couple of deals, we've seen some protection in the amendment provisions against subordination. So some enhancement there. But interestingly, some changes have gone the other way. So between launch and pricing, we've seen a wider high watermark provision that gives the issuer more flexibility to permanently upwards adjust their EBIT, their basket capacity. We've seen some expanded test date flexibility. We've seen ratios exclude more debt rather than less. And we also, in one deal, saw the addition of permission to conform the bond to SFA terms without consent. So really just, making the bonds fall in line behind whatever happens under the SFA. So again, a little bit of a mixed bag on that front. And I will turn it over now to Ahu, who's going to take you through on the loan side.
Good afternoon, everyone. So I will now set the scene for where we are in the European leveraged loan market as we close out the second quarter of 2026. So the headline is simple, and I want to talk about volume. The market has moved well beyond recovery mode to full throttle issuance mode. To give you a sense of scale, June alone produced a record-breaking 53.2 billion euros of loan volume. To put that into perspective, that single month exceeded many entire quarters we've seen in the past years. Issuance leapt from a very quiet 6.7 billion in April to 28.6 billion in May, and then ballooned to the extraordinary June figure. Total Q2 volume reached 88.6 billion euros, surpassing Q1, and the first half volume is already at 64% of all 2025 full year issuance. So what's driving all this? The bulk remains refinancing activity around 36%, then followed by extensions roughly at 28%, and repricing is at about 22%. New money for actual M&A is the smallest portion of all, approximately at 9% for in relation to LBO-related activities, and about 4% was non-LBO M&A. But that M&A number is actually decent in context, at 9.3 billion euros in Q2, roughly matching Q1, and year-to-date M&A volume of 18.8 billion is ahead of the 15.8 billion that we saw in the first half of last year. So, and looking ahead, LFI estimates an underwritten pipeline of over 18 billion euros in euros and sterling debt to support LBO and M&A activity based on already agreed transactions. So when you consider that loan and bond financing priced for buyouts and M&A so far this year amount to 23.3 billion, that pipeline is very significant. So supply should be quite healthy into H2. But here is what really matters. Alongside all of this volume, Q2 saw a stark increase in aggressiveness in documentation. As we will see on the next slide, the flex data suggests that arrangers are locking in borrower-friendly terms at a very early stage, at the mandate stage, and syndication timelines, which are tightening, are leaving very little room for lender pushback. So the pendulum has swung, firmly in borrowers' favor. So the question we'll explore today is whether this looks structural or cyclical. So let us dig into what has actually changed in documentation during Q2 compared to Q1. So the short answer is almost every major aggression indicator moved further into borrowers' favor. Let's start at the top with uncapped EBITDA adjustments. You'll all be familiar with that. So they, of course, inflate reported leverage ratios and effectively loosen the covenants. The percentage of deals featuring uncapped adjustments ticked up from about 7% in Q1 to 9% in Q2. This is a clear upward trend after the relative lender-friendly discipline we saw at the end of last year. Inside maturity carve-outs, they increased from around 52% to 58% of the deals. That's a meaningful number because inside maturity debt can structurally subordinate your senior debt. Portability also rose sharply, but I will come back to that later in the slides. In LBO deals, zero ticking fee period So this is the window during which the commitment fee is waived before the facility is drawn. That window has been extended significantly. This is a real economic gift to the borrowers or sponsors. Then the J-curve blocker, which prevents the borrower from moving IP or other material assets outside the restrict group. It saw a notable decrease. It fell by about 11 percentage points compared to Q1, and roughly a quarter of the deals in Q2 did not include a J-curve blocker at all. And this is, we would say, a significant erosion of structural protection. Asset sales sweeps, the step down increased to about 81% of deals, meaning more borrowers can avoid prepaying the senior lenders and use them in any way they want. And then last but not least, day one basket capacity in general purpose debt, general RPs, or unrestricted subsidiaries investment capacity increased. They all moved upwards. Pulling this all together, Covenant Review's composite documentation scoring tells the story clearly. On a scale of 1 to 5, where 1 is the most protective for lenders and 5 the least, H1 2026 cross-border deals have become increasingly aggressive. Cross-border deals are again the least protective cohort, and unlike US-only or Europe-only deals, cross-border documentation shows no retracement towards lender-friendly positions on key terms like uncapped EBITDA adjustments. And one other point I want to highlight is that many recent repricings and amend and extends weren't just simple pricing exercises or extension. They were effectively full covenant package renegotiations with sponsors using the leverage of a hot market to basically make their covenant looser. Now, let's focus on two specific documentation trends that deserve particular attention. The first one is portability. This has been one of the most talked about features of the documentation trends in the European leveraged loan market over the past couple of years, and Q2 confirms that it is becoming entrenched. So in Q 2026, portability appeared in almost a quarter of the deals, up from 11% in Q1. That is more than a doubling, and critically, it was flexed in only 2% of the cases, down from 6% in Q1. In other words, when portability goes into the term sheet, it is almost never removed during syndication. And what is more is that we're noticing that the conditions are becoming more aggressive and looser. So we have seen loosened ratio tests this quarter, leverage conditions set outside of opening leverage, whilst market convention has been to require at least opening leverage. And then we're seeing very broad permitted investor definitions without AUM conditionality or specific investor whitelist. And there are overly long periods for entering into the relevant SPA with the permitted investors, which gives the sponsors more runway. So the message from the sponsors is clear. Portability is now viewed as a baseline expectation and not as a negotiation chip. Second, and I want to flag this carefully, the watch list. In this quarter, we've seen one of the most aggressive covenant packages in recent memory, which includes two provisions which are genuinely off market. The first is the highly controversial anti-cooperation provision. It's not only highly controversial, but it is also off market. They attempt to restrict lenders from organizing collectively by forming, say, ad hoc groups or coordinating voting strategies. Although the enforceability of these provisions is debatable, their inclusion sends a very clear signal about the sponsor's attitude towards lender engagement. In the example that we've seen, creditors were required to seek the company's approval before entering into any coordination or cooperation agreement. And the failure to do so would mean that the lenders would be treated as a defaulting lender. We are aware of similar anti-cooperation agreement language having been attempted in a very small number of other deals in the past year, but they were flexed out at each occasion. The second is an anti-law firm provision. This was the first we have seen in a European deal. This one restricts the lenders from retaining or sharing information with certain specified law firms named by the company up to a certain number. These law firms will be presumably known for advising creditor groups in restructuring situations. We are aware of these law firm blacklisting provisions in a very limited number of US deals, but this is definitely novel in Europe. This is frankly extraordinary and a test of how far the market will tolerate sponsors constraining lenders' ability to protect their own interest in restructuring scenarios. So whether these terms will clear the markets will be an extremely important indicator of just how far the pendulum has swung. If they become accepted, we are genuinely in uncharted territory for European leveraged finance. And another one I would like to mention is in a slightly different category because it has cleared the market, but we are monitoring it because it's almost always slightly overlooked. This is covenant suspension provisions, and we've seen one in whereby during an amend and extend transaction, whereby a qualifying listing allowed existing security to be released. So. And this was included in an A&E, as I said, and allowed for the whole guarantee and security package to be released upon a qualifying IPO. And they have now launched that IPO, meaning that they can release the entire security package. And at the time, they included that qualifying listing related provision. The qualifying listing leverage ratio was already outside their current leverage. So this shows that closer scrutiny needs to be paid when drafting these provisions, as opposed to just including cookie cutter provisions, because you can be left with fundamentally zero security after you effect this A&E or this amendment exercise. Then moving on to the next slide. We're going to focus on flex, and I would argue that the flex data is actually the most telling indicator of the market dynamics right now. Historically, this has been a key mechanism during which the market corrected itself. In Q2, flex heavily favored borrowers, and the more important trend is that there is visibly less flex happening at all. Arrangers are increasingly relying on the initial term sheets, which are becoming longer and longer, driven by tighter syndication timelines and, as I said, completeness of documentation at launch. The result is fewer variations between term sheet and the signed SFA. So let me give you the headline numbers. Uncapped EBITDA adjustment, 19% flex in Q1, down to just 3% in Q2. J-Crew blockers, 27% flex, i.e. included in Q1, down to only 7% in Q2. And remember, more than a quarter of the Q2 deals did not have a J-Crew blocker. And some aggressive terms did not get flexed at all during the quarter. These are inside maturity carve-outs, Altice risk, meaning no builder basket ratio test for investments, and freebie tranches being carved out from MFM protection. These were not flexed at all. The only provision that saw meaningful flex was the highest watermark EBITDA provision, which was flexed in 16% of the deals, making it the most frequently flexed terms this quarter. So the conclusion here is significant. If the market can absorb record-breaking issuance volume without meaningful flex on aggressive document terms, then the current borrower advantage seems structural and not seasonal. This slide puts it all together visually. The chart shows the flex rate for each of the most permissive terms, that is the percentage of deals that launched with a given aggressive provision and subsequently dropped it during syndication. What this chart tells us is that the deal terms we see in initial term sheets are overwhelmingly the deal terms that you get in final documentation. The flex mechanism, which for years was lenders' primary tool for pushing back, is barely functioning in the current environment. So the message is for investors and lenders that your engagement needs to happen earlier, because better at the mandate stage than the term sheet stage. because if you don't intervene at the mandate stage or term sheet stage, you're unlikely to achieve any meaningful document improvement during syndication. So, yeah. The next slide shows the covenant review default protection scores plotted over time. It's on a 3-month rolling average comparing European and US loans on that 1 to 5 scale I had mentioned earlier. The key takeaway from this chart is convergence. Historically, European leveraged loans offered meaningfully stronger documentation protection than their US counterpart. That gap has been narrowing for several years, and by mid-2026, the lines are essentially sitting on top of each other. So European loan documentation is now about as aggressive as US documentation. Then with this, I will hand over back to Shoshanna.
Great, thanks, Ahu. Along with the comparison of EU and US loans, it's always kind of interesting to see how EU loans and EU high yield compare. So we've added a couple of slides here comparing loans to bonds, or specifically loans to sponsor-backed bonds, so that we get a more apples to apples comparison. And this first one here shows average minimum day one capacity under capped baskets of non-ratio based baskets for general purpose debt, general restricted payments, and investments in unrestricted subsidiaries. And you can see here that the longer term trend has really been for loans to outpace bonds. So there's more capacity on average under EU leveraged loans than EU high yield, which is, as we've spoken about on previous webinars, is a little bit at odds with that historic narrative about bonds being more permissive than leveraged loans. But focusing on this quarter, for the most part, that trend continued. Loans had more capacity for debt and for unrestricted subsidiary investments than bonds did, but somewhat unusually, that wasn't the case this time around for general purpose RPs, where bonds had just a touch more capacity than loans. So it'll be interesting to see if that reverts next quarter. And next up here, we've got a little bit of data on savings and synergies, Addbacks. And here the trend has been more in line with that narrative of bonds being more permissive, with uncapped Addbacks far more prevalent in bonds than in loans over the periods that you see here on the slide. That trend did continue in Q2, but it wasn't quite as extreme as Q1, which may have been a bit of an outlier. For Q2, about a third of the sponsor-backed bonds permitted uncapped Addbacks, compared to about 11% of loans. Where there was a cap, however, as you can see on the right, they were fairly close across the two asset classes at about 24%, in each case a little bit tighter than what we saw in Q1. Now, on this slide here, we've got data on 4 key covenant terms. 3 of them are, I would say, permissive terms. So we've got pick your poison debt baskets that let the company convert restricted payments capacity into debt capacity. We've got portability provisions, and we've got a leverage-based step down in the asset sales covenant. While the last one on the page is at least theoretically a protective term, a J-Crew blocker. So in Q2, loans pulled ahead of bonds for pick your poison baskets and asset sales step down. So again, signaling a more permissive regime under loans compared to bonds. Different story on portability, which remains far more prevalent in bonds than it does in loans. But as Ahu just mentioned, it's definitely trending upwards. It's not getting flexed out when it does appear. So it certainly seems like loans are moving to catch up on that term. And then last on this slide, when it comes to J-Crew blockers, Q2, these again appeared in more loans and in sponsor-backed bonds. So maybe that's distracting a bit from some of the more permissive features we've just discussed. Again, as Ahu mentioned, it's fairly common to see a blocker get added in flex terms. But it's interesting to see the sort of convergence in terms of percentages between the two asset classes. We're getting to the end of our time today, but before we finish up, I just wanted to briefly mention some of the ongoing litigation in relation to some liability management transactions that have happened over the last couple of years. The Selecta case remains ongoing in New York. It's still moving through the motion to dismiss stage. There's so much that's quite interesting about this case, and it could have a really significant impact on liability management generally, not least, of course, the antitrust claims that are related to the co-op agreement. in that case. But one thing I did want to highlight that we covered over the quarter are the arguments that have been raised in relation to the claim that the distressed disposal mechanic under the ICA that was used in the Selecta LNT violated the English law minority protection principle. Now, over the last couple of months, there have been some dueling declarations on that point from English law experts. They make for really interesting reading. We've covered them in detail. But in a nutshell, the defendants are taking a really textual contract driven approach. They're arguing that that principle, if it exists, can be overridden by the express terms of a contract, and that it was in fact overridden by the express terms in Selecta's intercreditor agreement. But the plaintiffs, on the other hand, are arguing for a more holistic view and saying, look, even if the express terms give you this contractual right, you have to exercise that power for a proper purpose. So the swords are crossed there from a legal perspective. We're watching with real interest to see how that plays out. It's really such a fundamental question for European liability management, given how prevalent English law governed ICAs are and the rise in use of this distressed disposal mechanic as an LNT tool. Similarly, in litigation regarding the Hunkemöller LNT is continuing. This time they've got parallel proceedings going on in New York and in the UK, where the plaintiffs are again raising this English law minority protection principle in connection with the distressed disposal under an ICA, as also a claim ongoing in Netherlands challenging the actual share enforcement. So we're watching that space. And then finally, I just wanted to touch briefly on Serta. I appreciate that's not a European LMT, but it's one that is obviously top of mind here as well as in the US. So just to make mention of the latest decision there from the U.S. Bankruptcy Court for the Southern District of Texas, following on from the Fifth Circuit's holding that the exchange involved was not a permissible open market purchase, meaning that the pro rata sharing provision in the credit agreement applied. This latest ruling held that that cashless exchange was indeed a payment for purposes of that sharing provision, with the consequent award of a fairly eye-catching amount of damages. It was certainly a headline-worthy decision. We've got a link to a really excellent analysis and explanation of it at the end of the materials here. But ultimately, as we say in that piece, it's probably of limited impact because new deals have already been drafting around the issue and the various decisions with exceptions to pro rata rules. So we expect that that will continue. And with that, we will wrap things up for today. Thank you very much for joining. We hope to see you for our Q3 webinar. And again, if you have any feedback, please do fill out our survey. Thanks so much.